If you look at sublease, right, when a company lists a space for sublease, they're telling you I'm not going to renew, or at least not at the same amount. And our subleases are the highest they've ever been in recorded history. Vacancy is it's the highest it's been in about 75 years, and it's the equivalent of about 16 Willis Towers worth of vacant office space in the city.
Welcome to Deals and Developments, a real estate podcast from the Dykema law firm. I'm your co-host, Bob Linton, Director of Dykema's Real Estate and Environmental Department.
And I'm Liz Darke, member of Dykema's Real Estate and Environmental Department. For more episodes, you can find us at dykemapodcast.com, youtube.com/Dykema Law, or by searching Deals and Developments, wherever you get your podcasts. On today's episode, Bob and I will be discussing the post-pandemic fate of downtown office markets with a very special guest, Farzin Parang, head of the Building Owners and Managers Association, also known as BOMA, in Chicago, a trade group whose members constitute 80% of all rentable office space in downtown. BOMA Chicago helps shape policy and raise awareness on a broad range of issues impacting Chicago's business community. As the executive director, Farzin is working to lead the charge in the ongoing efforts to combat the record high in downtown office vacancies.
Farzin, why don't we start out with some statistics? I know you've got some of those. Tell us about current occupancy rates in Chicago, the Central Business District.
Yeah, it's been relatively stable, unfortunately. We saw a little bump so far in our latest survey. For September, we were up to 47% headcount occupancy on the busiest days of the week, which is up about 3% from our August. It's been, for the last year, it's been relatively stable. In September of last year, we were about 42%, dipped a little bit over the winter. We're pretty stable over the summer. So really, we haven't seen a huge jump since spring of 2022, which was we went from something like 20% up to sort of mid to high 30s. But it's been relatively slow trending from there.
Yeah.
And that's, of course, on the busiest days.
Yeah.
Monday, Friday is still something like 10 to 20%
Yeah.
occupancy.
Well, Liz and I work downtown, and just at our firm, we're now, our firm's targeting 3 days a week, Tuesday through Thursday. Certainly, there's some people that come 4 and 5 days a week, and that's welcomed. But the real peak in occupancy that I see is those Tuesday, Wednesdays, and Thursdays. When I'm on the train, I commute on the train. If I come in on a Monday or a Friday, it feels like a Saturday used to feel pre-pandemic. It really is a noticeable change, and you notice it in the restaurants too. And I guess that kind of leads to a follow-up question on the return to office push that the employers are doing. That seems to be kind of going against the headwinds of kind of the how office use has evolved since the pandemic. What do you see, Farzin or Liz, jump in, and what are you hearing companies are doing to try to get people to return to the office?
Yeah, it's kind of funny. I think in the beginning of the pandemic, for whatever reason, everybody was tracking holidays, right? It was going to be okay after July 4th, everyone's back in the office, and then it was Labor Day, and then it was New Year's, and you still feel that, right? You still hear, I think, lately, oh, it's going to be after Labor Day, but it has been a much more distributed. I think as much as employers may want sort of a cohesive, okay, now everybody's going back to the office, and data indicates, I think BOMA International did a survey. Latest survey was something like 86% of companies and management saw value in the office and wanted people in the office more. But there's that sort of tension between having flexibility on the labor side. And so it feels more like it's just been distributed across different teams and different managers. And it's a lot less, even where you have pronouncements from on high about return to office, it feels like in practice, it's been a lot more, even the implementation of that has been more flexible, and the enforcement of it has been maybe not what people anticipate. And so I think that's why you're seeing kind of just a slow, I'd like to say steady, but it's a little bit back and forth, but a slow increase over time. and I think it's been different too across industries. The financial folks obviously have been pretty heavily since the beginning arguing for return to office. Tech companies were, I think, a little bit in the beginning. They were the ones saying, well, everybody can work from home, but they also have a very different sort of supply and demand for their talent pool. It's very difficult in the labor space or the tech space. So, but I think now you're seeing more of them saying, okay, we want you back in the office. Actually, law firms, I've heard both ends of the spectrum on law firms. In the beginning, it was law firms are all going to be in the office. Partners don't know what to do outside of the office. And then now I hear actually the opposite. Like partners are used to being at home now, but your associates feel like they're not getting the mentorship if they're not in the office. So I hear it all over the place.
It's a puzzle.
There's a article I read that said Davis Polk expanded their lease in New York, Midtown Manhattan. They expanded an additional 30,000 square feet to 700,000 square feet. Alternately, Cat and Muchin in Chicago, their office manager announced that they were taking 22,000 square foot reduction in their lease. I think it just goes to show you how it's different in different jurisdictions and the culture at the law firms.
There's another AM law firm that created a virtual office, so they've got their physical offices in Chicago, New York, wherever, but then they have a virtual office, so there's a different track, and I don't know if that's a different career track and partnership track or just an accommodation and an acknowledgement that here's this subgroup of people that maybe because of their family situation or where they live, how far their commute would be, or they're not by an office, who knows, or they just don't want to come in the office, but they're accommodating them and they've got them in the quote unquote virtual office, and it's part of their structure. So clearly companies are adapting and changing. And Farzin, to your point about tech companies, even Zoom has recently announced a push for return to office. So that's the ultimate kind of irony.
Yeah. I hear it too, even across the different size of companies. I've heard people say the smaller tenants are the ones that are in the office all the time, most consistently, and then I hear the opposite too. It's really I just heard somebody in the suburban market was saying it's really the big companies in the suburbs are in the office more than the small. So it's at the end of the day, I think the only conclusion I can draw is that it really just depends on the team, company, industry, everything.
Yeah, there's been some discussion, anecdotally too, and maybe I've read some articles about it, about being generational too, right? Like the quote unquote older people, the people that have been working for decades, and for decades they're used to getting on the train or doing the commute on the highway, showing up in the office. It just feels more comfortable, and they may be happy to only come in 4 days a week and have that Friday at home. That creates a kind of a new flexibility, but they are unhappy being fully remote and miss the collegiality and the focus kind of in the separation of home and work. But then you've got young people maybe who are in a studio apartment and their significant others also working from home, and they're like, I can't, or they have young children, I can't get anything done, so I want to be in the office. And to your point, some young people feel like their career is going to be better served if they're being mentored and being seen by the managers and stuff. So
it's I draw a little bit of a parallel to really just the internet. So I'm of that generation that remembers what it was like not to have a cell phone, right? And I remember when AOL started and all of that. And I think about that because in this context too, like I've had both ends, right? I mean, I when I was young, we were in the office all the time, and I benefited from that in terms of career development and building relationships. I'm not anywhere near retirement unless someone tells me otherwise, but I'm still enough in my career that now I kind of see the pros and cons of remote work. But what strikes me as kind of a sad thing is that the young generation, they don't really have a comparison.
Yeah.
Right. I mean, it's possible for somebody to be remote. In fact, we have somebody on my team that this is the first job she had. She first office-based job. She was remote. And I feel like that's a not to start waxing poetic about generations, but that seems like a unfortunate situation that you don't have the comparison to really be able to make that judgment of what are the benefits and drawbacks and what's the right balance for me, because you don't really know. Even if you're in the office maybe more than your colleagues, the fact that you're maybe more than your generation, the fact that maybe the people who would be your mentors and the rest of your colleagues are not in the office as much as they used to be when everybody was in the office is kind of it's a loss, I think. Not to discredit, we try always to say we're the office industry, but we're not a cult, right? Yeah. We believe in the value of the product of office. So we're not always, everybody needs to be in the office every moment of the day. But it does seem like there's something unfortunate about that you could go 10, 15 years and then you realize, I really missed out on a lot of opportunities and relationships and career development that maybe somebody else did. You wouldn't really know until maybe too late.
I mean, we've really dived into this return to office subcategory, but it's really at the heart of this. This is why the office market sector is performing so badly, and let's talk more about that and its impacts.
Yeah. I mean, even then, we'd spend a lot of time talking about return to office because I think it touches people directly. But then, what's the connection between that and what really, in terms of the industry, matters is leasing. And leasing, I mean, it's typically about almost half of leases are downsizing. It's the latest data I heard. I think it's about 46% of lease renewals are downsizing, and that's typically 20 to 40% of their space. Nationally, there's about 50% of leases are expiring in the next 2 years. I wish I had that number for Chicago, but it's very much still a sort of a developing, ongoing train wreck. And the lease terms are shorter too. It's about 45 months average lease, where pre-pandemic it was more 10-year range. I mean, the quarter that we started out this year was the lowest level of leasing activity in the last 5 years, and you just feel those ripple effects. I mean, the three stats I often tell people, because I think they're the most indicative of where the state of the industry. One is the occupancy. And I like to flip it. I tell people, if you really think about what that 45%, 47% occupancy is on the busiest days, our buildings are half empty of people on the busiest days. If you look at sublease, right, when a company lists a space for sublease, they're telling you I'm not going to renew, or at least not at the same amount. And our subleases are the highest they've ever been in recorded history. Vacancy it's the highest it's been in about 75 years, and it's the equivalent of about 16 Willis Towers worth of vacant office space in the city.
Wow.
So it's bad both present and the sort of projections into the future. This will be, I think, very much a multi-year, especially because the office, if you're looking at the occupancy as being kind of the driver of all of this, the margins that we're talking about are 40, 50, maybe 60, 65%. They're relatively small margins. So if a company at the end of the day is using half of the lease, half of the square footage, you have to have twice as many companies at the end of the day, or obviously a much, much less office space. So it's going to be, I think, a long-term workout. And historically, Chicago, kind of it's both a strength and weakness, but when you compare us to other cities, we tend not to have a lot of sudden variations, right? In pricing or other things, we tend to have very kind of slow collapses and very, very slow increases. We just, I want to say it's over the last few years, it's the first time we've actually gotten to pre-2008 sort of total assessed value in the property tax context for our real estate industry, which is lagged behind, most of our competitor cities. So in some cases it's good. We don't see kind of quite the same bubbles other folks do, but it all kind of, to me, points to a relatively slow, long-term attempt at recovery in the market.
Farzin, how has this lower occupancy and shorter work week affected transportation and downtown business and the local economy in general?
Big picture, the most of the other industries are bouncing back, certainly better at least than offices. You had, obviously, in the retail context, you had struggles in the retail industry even before COVID, but I think in a lot of cases they're doing better. You're starting to see more activity in retail, and they're doing their own sort of reinvention with more of these immersive experiences and things like that. Same, I think, with restaurants. Obviously, it was a big impact in the middle of COVID, and you're seeing slowly some more of those open, although that industry has its own series of challenges with labor force and their own new if you're following their increases in the I'll say minimum wage, it's really the reduction of their tip credit, which I think is a pretty big deal for that industry. So it's really, at this point, office is the lagging factor. And in fact, if you're downtown, generally, you see a lot of crowds, and there's been a big disconnect for some time about, depending on what's going on, you see big crowds, and there's been a disconnect between that and the office occupancy numbers. And even on the CTA's end, they're seeing about a 76% ridership compared to pre-COVID on weekends. And during the weekdays, it's about 66%, which again kind of indicates it's slower in the office context. And they're attributing that, I think, mostly to special events and also students returning to school. So they've seen the highest, bigger uptick in September and August than they have in some time. But you're still, I think, feeling that impact from the lack of those very steady riders from the office. It's also kind of an interesting. There's a logistical challenge because you also, when you have office occupancy, it's the time of day is spreading out a lot more, and so it used to be very simple to organize. We've heard this from both CTA and Metro. Used to be much simpler to organize their service schedules around morning and late afternoon rush hours. And now they're all trying to sort of optimize and spread that service out a little bit. Obviously, in the context of their own fiscal cliffs. I mean, I think I heard it was something like $700 million to $1 billion fiscal cliff in the CTA from lack of ridership, which we attribute primarily to drop in office and remote work.
Yeah, what I had heard, I think it was an article in the Wall Street Journal this week. They said that the biggest drop, I guess the cities that have been affected most are those that have the greatest commute time. So it had less to do with whether you're in a red state or a blue state and more to do with how long is your commute. In Atlanta, for example, there's a long commute time. In LA, so there's fewer people using public transportation, wanting to drive into work. Therefore, that affects the occupancy rates, et cetera.
Yeah, and it's even the cities differ in terms of how dependent their downtowns are on office as well. So the more sort of distributed you are, I think it's about 70% of Chicago's downtown square footage is office. I think we're the fourth highest among U.S. based cities, and so there's that too, which is not only a transit related issue, but also a tax base, a big challenge for the tax base.
I've seen Metro get creative on their pricing and in their monthlies going down and having like day passes and weekend passes. And I don't know if CTA is doing the same thing or not. I ride at CTA, but I just haven't noted that.
I think they're having those conversations. I don't envy them that challenge because it's also still a fluid environment. And then obviously on their end too, that they are struggling for resources. So I assume you don't have a lot of bandwidth to experiment. I mean, there's a whole conversation about merging all of these entities. So CMAP has been, the Chicago Metropolitan Area for Planning has done some recommendations that I think we're with that concept in mind, although their final recommendations have been very gentle, but there is now a big broader public policy conversation about, you have all these agencies that are struggling and they're obviously very vital to our economy. And what do you do with them, and how do you kind of account for that?
And one other thing I've heard just in the abstract is the public transportation. They're trying to do a better job of drawing ridership to the special events, to the theater, to the sporting events. So they need to evolve. Like the formula that used to work doesn't work post pandemic.
Yeah. And then now is the opportunity for them to do it, given that more people are driving and that annoys other people, and you have all the construction going on the highways. So
yeah, right.
There's an opportunity there to make that pitch.
Right. So let's talk about kind of what's going on in the background with this lower occupancy and this lower leasing activity, and that is sales activity or lack of it, and lower trading values. One statistic I read is that the volume of commercial property sales in July was down 74% from a year earlier, and sales of downtown office building hit the lowest level in at least 2 decades, according to MSCI Real Assets data research provider. So we're hearing and we're reading about property selling at less than half of what it was valued at or bought at in 2019 in downtown San Francisco, in Chicago, New York, Atlanta, all the major cities. And we're also hearing about a lot less activities because people can't sell. the lenders won't let them sell at that lower rate because the mortgage is worth more than the property. It's kind of like a time bomb, like I think you mentioned earlier, Farzin. When they do sell, they're going to sell for a lot less, and in a lot of cases, the hand's going to be forced by the lenders. So I'll put this to Liz or Farzin. What are you hearing or seeing? What solutions or uh, you know damage control plans do the lenders or their receivers have in this situation?
Yeah, I would say right now it's a little premature. I mean, we're not seeing, I think the defaults, while they look more certain and they're coming, there's a lot that goes on behind the scenes before that happens and before the properties start getting sold. Right now, I would say that the wave of negotiations is just starting, and the bank and the borrower are talking. I think the banks have been, uh, trying to kick the can down the road a little bit, and whether it's extending the loans and trying to get more cash infused in the properties. That seems to be, where we are right now. I don't think you see a lot of places, a lot of these buildings going into receivership just yet. Although I think that there will be, it's going to come. It's just a matter of when, and I think then you can see how things play out from a solution standpoint, whether that's conversions. But the banks don't want to hold these properties, so they're not quick to take the properties back.
Yeah, I mean, we've had I've seen an estimate that 50 in our sort of specifically downtown office, 50% of our buildings are in some stage of that spectrum that Liz is talking about. Either on one end full on foreclosure, receivership, and on the other end having some cash flow issues and needing to do sort of loan workouts. Um, so I mean, in terms of sales in our market, we haven't had any. We just had one. Our first one this year was I think announced in the last week, and it was at a 60% loss in value. So it's hard to peg what that is. Especially in the property, we do a lot in the property tax space, and it's been a challenging few years to really talk about what the value and loss of value in office is because you don't really have transactions. But we're hearing everything from 40 to 80% loss in value. That's just kind of waiting, I think, to Liz's point. And I think the solutions will vary a lot. I mean, there's some buildings you could convert. A lot of building that's challenging for a lot. There's a big geographic component of this too, right? I mean, there's a lot of our older buildings in Chicago and sort of the downtown core and LaSalle Street and in the vicinity that theoretically would be good candidates, but they're landmarked and just they're in very tight, low sunlight areas, and floor plates and all that are not great for conversions without some sort of public benefit. So it's even that. Well, what do you do about it is I think going to be very building dependent. I heard one that somebody on our membership has a property that they actually think high likelihood that the owner, defaults, walks away, and the lender will walk away from it, and it would actually, go back to the state, which is just hard to fathom.
It's hard to fathom. Yeah, I wonder if that's happened in our lifetime. I mean, it's incredible.
Right. Yeah, it's a big challenge, and my understanding is you can both, I think, speak to this better than I can, that historically conversions to hotels were often kind of a good option for an office building that was getting older. But even hotels, I heard the head of the Illinois Hotel and Lodging Association the other day said the hotels have lost half of their value too. So that hasn't been a great option. And then that kind of just leaves you with residential or maybe some sort of student housing. And then that's obviously difficult with a lot of these floor plates because you had all these requirements for natural light and things like that. That's hard to get into some of the core of these buildings. So it's a big challenge. I mean, one thing we often point out to folks too when we're talking to elected officials is in Chicago, this is not entirely a COVID era challenge. If you look at the data on the sales of office buildings, and you can look at it from dollar amount, square footage, number of buildings, it tells you sort of the same story. We were pretty competitive in like 2011. We hit a peak in 2015. In 2015, we had more sales than any of our competitor cities in the country, except for New York, which is a just different, different scale altogether. And since 2015, we've seen a pretty consistent drop in sales activity in Chicago. Even in 2019, it was, I think, a third or a fourth, maybe even, of what it was at our last peak in 2015. These things are generally cyclical, but we always point out too, there's a big public policy connection. We often remind people that if you follow any of the, it's been a long-term dialogue now about pensions and pension liability in Chicago and even the state. But in 2015, the city started increasing its payments into our pension system to what's called an actuarially required contribution. So essentially, they started paying in to the pensions the amount that they should be paying in the pensions to keep them solvent. And the way that they do that is by raising property taxes. So in downtown, in that period of 2015 to say 2019, you had about a 40% increase in property tax bills in the office sector, which subsidizes everybody else. And you do see a pretty correlated drop in the sort of investor interest in the office buildings. Again, even pre-pandemic. So we like to give that context a lot of times when you're talking about public policy, even post-pandemic, is trying to maintain our competitiveness for whatever those options are, whether it's the lender or the original owner. At the end of the day, you're trying to get investment, whatever it is you're trying to do to the building. And so being mindful of our tax environment and just generally public policy environment is will play a big role in how we shake out of all this.
You touched on a lot of good points there. I mean, the adaptive reuse it can be very expensive, and you're right, it only works for certain types of buildings. But if the value of the office building drops enough, and here we're seeing that it could be 40, 60, 80% at some point, it can make economic sense, and that's what we're seeing. And there are some planned residential conversions. They need smaller floor plates, like you said. It wouldn't work for Willis Tower. They need light, and retrofitting the plumbing is just an incredible expense. The older buildings, I think, tend to have the smaller floor plates, and so you may see that more. And I think that's part of the whole LaSalle Corridor, the LaSalle Reimagined initiative. And from what I've heard, there is still more demand for residential space, and certainly affordable residential space. And that's where the city's coming in with this LaSalle Reimagined plan. So I think there's a lot of obstacles and hurdles for it to get up and running and succeed, but it seems like maybe one of the forefront plans that the big cities, I don't know if they're doing anything like that in New York or Los Angeles, for example, but I think Chicago is kind of at the forefront with that.
I think for sure we definitely were. It's always, we support that LaSalle Reimagine initiative, and I always tell people, we are literally, the office industry is supporting the conversion of, I'm losing members, right, as a signal of how important, how dire the situation is, because at least it preserves something and gives you a better base for the future for office buildings. But I think in the beginning, my impression is we were very much a leader in that space, and I've heard from other BOMA locals, and it's even my understanding from the city that they were getting calls from other cities and we're a little bit of a model. I'm not sure that that's quite the case anymore. We obviously had this mayoral transition, and the new administration, I think, is uncertain of what they're going to do, if they're going to continue that program or not. And I've heard, I think somebody mentioned Boston to me recently as being they are in the process of rolling out sort of their own version of the program. So I'm not sure. I think certainly we were a leader in the space. It's still, I think, a big question mark whether this administration continues that program or really affects it. There's sort of two parts. One is that conversion of residential. The other is some grants for retail level to fill retail level vacancies. And I think that part is continuing, but the bigger piece about the conversions is a little bit up in the air.
I wanted to touch on one other thing you mentioned, Farzin, which was even pre-pandemic in 2015 through 2019, less new construction in the city. I just anecdotally, I noticed walking around, you notice where the cranes are, right? And they all seem to be in Fulton Market, right? I mean, or 90% of them. And my sense is that is hotel, it's boutique office, and or build to suit office for specific companies like McDonald's or Google. Those two were really the two that anchored that redevelopment. But there's obviously a lot of entertainment and retail and dining there,
And
and
residential,
it's
a
a
lot.
thriving
Yeah,
area.
a lot of it's mixed use, and I heard I often, this is helpful for me as context because I'm not originally from this industry, but for all the attention that Fulton Market gets, it at least into the last year or so, I mean, all of Fulton Market was smaller than Willis Tower. I mean, it's not a very
It's small.
large
Yeah,
part of the sort of office office sector in Chicago. Um, but yeah, there are a few different sort of tech neighborhoods. Boston has one. I think all bigger cities have one that have been relatively resistant to COVID in terms of getting investment. Somebody told me recently that even Fulton now, I think also because of interest rates and everything, is a lot of those um, deals are starting to struggle.
mm-hmm.
But I mean, you raised kind of a point we didn't talk about in the sort of different occupancy et cetera context. Is it's just like occupancy is different with between companies. The type of building is different, right? I mean, you are getting that flight to quality where the Class A sort of newer office buildings are generally doing better in leasing and generally a little bit higher in occupancy as well, because that is part of the tools that the big employers that want people back in the office have is they spend on fancier, nicer office buildings that have more amenities to try and encourage people to come back. And there's others, if you talk about medical office buildings and life science buildings, even throughout the pandemic, possibly because of the pandemic, we're still seeing more investment. The downside for Chicago is we don't have a lot of that. It's
Yeah.
my impression that we're punching kind of below our weight in terms of life sciences, especially.
So it's not really, for example, Fulton Market is not necessarily a model for downtown. It's more just kind of an exception, but it's very limited in scope.
It's limited in scale in terms of the overall kind of investor interest you're getting, and I've heard people say that it is a model for everywhere, right? That you want these mixed use neighborhoods, and there's appeal to that. I think that the challenge is, you're not going to get that downtown unless you start getting rid of buildings altogether, right. and a lot of buildings, and then you get into landmark and other issues.
Well, and the amenities, you're right. And amenities used to be a Starbucks in the lobby and a gym, right? And now it's so much. You got to have a roof deck and public space and open space and a dozen other things.
A pool table and ping pong table.
Right.
Yeah.
Coffee shop.
Related. It did Hudson Yards, and they're here too. Yeah. Hudson Yards and they're here. They've seemed to have carved out this niche of like the ultra high end, both actually in residential too, but in office. They have this. I don't know if you've seen it. It's a design for a new office building, very tall. I don't remember that, but high rise, kind of in that corner of Fulton Market and the highway, and it's amazing. I mean, every floor has an outdoor balcony, like every single floor. I mean, it's really leaning into that theory that there are bigger companies that need their people back in the office and will pay for that. So it even that kind of varies, and I think is case by case.
Well, this has been a great discussion, and as Liz said, there's some subtopics that are fodder for a complete separate podcast. So maybe we'll get to those someday. But that's it for us today, and thanks to our special guest Farzin of BOMA Chicago for taking the time to share your deep knowledge and valuable insights on these topics with us. And again, my name is Bob Linton.
Yep, and I'm Liz Darke, and I want to thank you also, Farzin. Appreciate your time. Thanks for listening, and as always, you can find us at dykemapodcast.com, youtube.com/Dykema Law, or by searching Deals and Developments wherever you get your podcasts. We look forward to seeing you next time on Deals and Developments.